All right. What is up, everybody? Welcome back to another episode of the Leveled Up Podcast with your boy, Mike Adler. And it has been a while. I apologize for the wait, but we're back. It's time to keep this thing going here on the Leveled Up Podcast. As you can see, things are a little different. A lot has happened in my life since the last time you guys saw me. We are now based in Florida. I'm in Eustis, Florida. We drove from beautiful Colorado to beautiful Florida. I'm outside in our sunroom area right now. Of course, it's gray and gloomy right now, but it's a whole different life. It's very different down here, but it's we're liking it. It's cool. Emery likes it. Jackie's got family out here. Got a big fenced-in yard. Joey here loves it. Got Joey outside here next to me. Probably can't see him, but I also just a lot going on. So I want to. Obviously, you know, this is the Leveled Up Podcast, and here we discuss leveling up in your life and in all facets. Here, I'm going to kick on this light and see. I have no idea how this is going to look. I don't have a monitor. I see this after the fact. But I'm going to turn on this light so that I can see if it's better or not. Maybe you can see my face a little bit better. Okay, so we talk about a lot of like personal development things here, and one thing that I don't talk about or haven't talked about a lot, because it's something that I have sort of just neglected or labeled as not important or not something I care about for many years, and that's finances, financial literacy, money. And I made a post about this not too long ago. I think it was on TikTok, but just about the fact that like what we say becomes a reality. And as I just mentioned, for many years, I would say that I don't care about money. Money doesn't matter to me. And at the time, naively or whatever, I truly believed that. I didn't think it mattered to me. But as I'm getting older and, you know, I realized I was so wrong, and I don't regret many things, but I do in fact regret the fact that I would say money doesn't matter and that I didn't care about it for so long, because it truly does matter. In today's world especially, it matters. It matters so much, and part of it was because I didn't realize that the more money you have, the more you're able to give, the more you're able to help. So, like, even if you're not into material things, which are actually really great because they push you to go further, keep going when things get tough. But even if you're not into that, sorry, Joey just freaked out about something. Even if you're not into that stuff, at least realize that you're able to help more people the more money that you have. There's a reason that many wealthy people become philanthropists. Because once you reach a point of financial freedom where you don't have to worry about survival, because so many of us are just stuck on worrying about surviving, that we can't even think about helping other people. We do think about it, we want to help other people, but we can't. We can barely help ourselves. We can barely keep our own lives together. But when you reach a point where you're not worrying about making sure your bills are paid and that you can afford groceries and everything, it frees up some mental bandwidth to be able to think about other people. And if you are someone who is naturally a giver, a helper, a philanthropist, it's hard to be that when you don't have the means to give. Sorry, this dog is scratching the door now. Joey, in or out? Come on. So that is something that really changed my perspective. Hearing that from successful, wealthy people, that they're able to. The more you make, the more you can give. Period. So for a long, long time, like I said, I deemed it as not important. And now my whole mindset around money has changed. But I am starting from ground zero at 35 years old. And it's something that, yes, it frustrates me because just the simple fact of compounding interest, if I had, realized how important this is at a young age, it just makes me think how much, could have compounded over the past 17, 18 years being a legal adult. But it is what it is, The way I see it is it's just okay, now I got to make up for all those years by finding a way to generate more than average income in a shorter amount of time, which I know I'm capable of. And up until recently, I wasn't sure how that would happen, but I feel like I now am able to see a path to that financial freedom that I'm after. And there is something that many people are unaware of, that they don't know about, and it is something that wealthy people, it's a tool that wealthy people often use, and you may have heard of it, where people become their own bank. And if you're unfamiliar with that phrase, I know it sounds crazy, but let me explain a little bit. There's something called an indexed universal life policy. It is technically a life insurance policy, but people use these to fund their life. And that may sound confusing because you think of life insurance, you think of final expense. You get a death benefit, you die, someone gets some money, and it helps cover costs of your funeral, and also, gives them some money in your absence. Now, with this, it has that aspect to it, but people don't really use it for that reason. Yes, you will have a death benefit, but people often use it for what it does while you're alive. And when I say be your own bank, this just fires me up, so I wanted to make a video about it because it quite literally is a way to level up your life, especially your finances. And it's something that so many people don't know about. It's once you hear about it, you're gonna be like, oh my god, I can't believe I didn't know about that. But right now, many of us are taught, you make money, save. But we're not told where. We're not told how. And so, we're left to go off what people tell us, that are the people close to us. And it's usually put it in a savings account or put some in, buy some stocks, and or an IRA, or like, at your job you have a 401k, maybe, but no one tells you about index universal life policies. When I feel like if people knew about this, a lot more people would be doing this. But it's like everyone I tell about it, like, what? I've never heard of this. I didn't hear about it. I mean, I had heard about it because I follow like a lot of entrepreneur pages and things like that, but like I didn't really understand it until recently. And so what it does is you make money. You have your money. And you have to put it somewhere. Most people just put it in their checking account and spend it. But when people say make your money work for you, what they mean is make your money grow without you having to do anything. And you do that with interest. And this life insurance policy that I'm referring to has an interest aspect to it. You put a contribution. Your premium, your monthly premium, is a contribution. You contribute to this policy, and that contribution then goes, and it does go into the market, namely the S&P 500, and different companies will, have different markets, but it's primarily the S&P 500 that it goes into, and that averages 10%. It's the S&P, and there's another. They're able to get higher percentage rates than the market alone. But, many traders will tell you, like, I can get 30% for, like, these crazy numbers. But the thing is, they may be able to get a higher percentage interest. But when the market goes down, all that they lose all that as well. So they get these great gains, but they also get these losses because the market is always up and down, With an indexed universal life policy, you put your money in and it will grow, but there's a cap and a floor. So it will only go this high and only go this low. Now that's huge. So, say it's capped at 15%, even 12%, someone will be like, well, I can get more than 12%. But the thing is, so you hit 12%, it stays at 12%. But then it drops to negative 20%. Your policy has a floor of 0. And after 10 years, or maybe even sooner, it's 2%. So it doesn't go below 2% or 0%. So when there's that fluctuation, your money isn't being played with in the loss section. You're only participating in the gains. So you'll stay at 0%. You may not be earning interest, but you're not losing anything. While everyone else is losing, you're staying the same. And then when it goes up, you'll start earning that interest. So that makes up for those people who say they can get higher percentages, because it ends up balancing out where if you're participating during the lows, during the negatives, that's canceling out all those high interest rates that you're getting. Unless you're someone who's like a competitive day trader and you're pulling your money out, or you're like, selling every time it's high, but most people aren't doing that. They're putting their money in. They don't want to have to watch it and move it around every day. Hey Joey. So that is the investment aspect of this indexed universal life policy, is that you get the wins, you get to play with participate in the upside, but you will not participate in the downs, in the lows, in the negatives. So that right there is so cool. But what's really cool about this is because you're putting money in, you're contributing money, a portion of that contribution is going towards that insurance, that death benefit that I had mentioned in the beginning. So a portion of it goes towards insurance. And what that does, because it is an insurance product, your money, the cash value that's generated in this policy is tax-free. So you do not pay taxes when you pull that money out, as you would with a 401k or an IRA if you pull out before 65 or whatever. You can use so you're contributing money. Part of it goes to your insurance, making it an insurance product, making it tax-free, not deferred, tax-free. And you accumulate a cash value that you can take loans from. This is what's so cool about this product, is this is where the be your own bank thing comes from. You're putting your money in and you're funding your life with the interest that is built off that you're gaining off your money. And it's all tax-free. So while you put money in, some goes to your insurance, making it tax-free. You can pull it out as soon as you want and as many times as you want. Obviously, you can't pull out more than you've accumulated, but you can say you've accumulated $10,000 cash value over in your first, year, and you want to whatever, you want to buy a dirt bike. It's $5,000. You can take $5,000 out from that $10,000 that you've contributed and accumulated, and you can buy that dirt bike, and you can pay it back, but you don't have to pay it back. And you're actually borrowing the money from the insurance company, not from your $10,000. So that $10,000 still is earning interest on $10,000 opposed to $5,000 since you pulled 5 out. You're still accumulating interest on the 10 because you took a loan from the insurance company. So you can pay that back to increase your interest, the interest you're making, but you don't have to, because the way they see it is they will pull it from the account value, or from the death benefit rather, if they have to, if you don't pay it back. But you pay it back just like you would, if you used a credit card or whatever. But you're still gaining interest coming in, whereas with a credit card, you're getting interest on what you owe. So it's such a better way that's why people do this, is because it's tax free. You don't have to pay taxes on the money that you pull out. It's just it's a way for you to grow your money, avoid taxes, and protect your family in the event something does happen to you. If you do die while you have this policy, it's the beneficiary is going to get that death benefit. The other part of this is people use it for a retirement plan, at least a supplemental retirement plan. Like, I don't know about you, but retirement is something like I have no plan for it up until now. Like, but what this does is you can accumulate this cash value over the years. You're contributing whatever amount every month. Say you stop contributing at 60 years old, and then you retire at 65. From 65 on, you can take distributions from that cash value and take it tax-free. It'll take the total amount. Say you've accumulated, over the years. It really depends on how much you put in and stuff. But, say you've accumulated $1 million over the years, and now you're 65. Now, from 65 till whatever, 85, 95, whatever year however you set this up, you could take out equal or more distributions of that remaining cash value. You could take out $100,000, every year or more every year, and it's still going to be earning interest, but it's essentially a loan. Just like if you borrowed that $5,000 for the dirt bike, it's like a $100,000 loan that you don't ever pay back, and the what's still in the account will keep accumulating interest, but every year you have money going straight into your account. You don't have to pay taxes on, and it's just there for you. And you can have as many of these set up as you want, because what's important is that you don't allow it to become what's called a MEC, a modified endowment contract. And that just means that the cash value is more than the death benefit. And if that happens, then it becomes this modified endowment contract, and that makes it taxable. So in order to avoid that, once you start accumulating too much money in the account, you just open another one, set up another one. So you have multiple of these going, so that you can have all this access to money without being taxed on it when you use it, which is so huge, because they find every way to take your money. So this is what people do. This is what people who are savvy with their finances do. And there's so many different ways to use this. So I'm just so excited to share this info with people, because so many people, like I said, do not know about it, and it can literally change your life and definitely help you level up in the finance part of your life. So I just wanted to share this with everyone. If this sounds like something if you want more info, reach out to me, and I can tell you more about. And if it's something you want to do, I can help you get set up with it. Just reach out. And then also, if you're interested in getting in shape, getting your mindset dialed in, hit me up for one-on-one coaching. And then, as always, I have my Get Fit Blueprint. If you're ready to have the body that you desire, get shredded, I can get you set up with that as well. So that's just an online video course. But I'm glad to be back. I'm so excited to be back. I'm going to start making episodes again. And yeah, we'll keep this thing rolling. And I hope that everybody's doing well. As always, thank you so much for tuning in. I hope this first episode after not having one for a while, gets you excited to keep coming back. So share this with someone who needs to hear it. Everyone needs to know about this. Share this with someone. Obviously, you might be confused a little bit. Reach out if you need to. You can hit me up at therealmikeadler@gmail.com. I'm not going to give you my phone number here, but email me or shoot me a DM on Instagram at therealmikeadler or TikTok at therealmikeadler. And yeah, let's make 2025 the year that everything changes moving forward for the better. Let's make this the best year of your life. And until next time, make your money work for you. We'll see you next time. Peace.